Yeah, during the 70s, people saw that some of the highest rates of inflation in the US's history. Interest rates, yeah, they did, which I'll show you later. 10 years after 69, the interest rates, it was crazy. The interest rates literally went up by 20%. That hasn't happened at all since 1982, I believe, or 1981. But I think it was 1982 that inflation went to 20%. It hasn't been at 20% ever since that year. And the Fed policy, yeah, which we'll read, they left the gold window. You had the Keynesianism, economic policy, the market psychology all contributed to the high inflation, yeah, which is like people selling onto that. Lower inflation would return only after a tough period of tight money and recession. If we look at 1971, a very important event happened here. And that was the end of the Bretton Woods system, unfortunately. Ever since its inception in 44. Yeah, 44. So you have 54, 64, yes, 74. Okay, so that's about 27 years. So you get 27 years of right economic expansion by using the currency. Now that's coming to an end in a way. Now, at least not to an end that people will utilize more. Like nowadays, it's been now, countries still utilize the US currency. They do because it's safer than anyone else's currency, right? Because that's still symbolized by the economic strength the US still has, despite it's not linked to gold. But this has been slowing down, of course, as years come by, and it will continue to slow down. It's inevitable that it will. And a lot of people don't like to face this sort of reality because they can't stand to imagine it. But there will, well, this is going to sound controversial. No, I'm not going to say that because many people might not like what I might say. And it's just something that's not going to happen until a very, very long time. It's definitely going to be something that no one else watching right now won't be alive by the time that happens. But you know what? What the hell? Because it's a reality. It's just going to happen at some point. But, the US is not going to stay at its dominant position forever, right? For the rest of the time, right? That's not realistic based on history. That's never happened before. And because of simple psychology. Think about it. This is just, and you know what? I don't want to go too much into depth because no one has the real answer to this. And I think it's just kind of a waste of time. But I do believe that it's important to understand that based on psychology, when your grandparents have gone through, let's say, a Great Depression or World War II, those people are now sort of people who hate violence in a way, or they want peace in the world because they've already been to a war. So those people are going to be less aggressive, less emotional, and less pounding towards a division of each other. They actually want to connect and unite each other. And that's exactly what happened in the 40s and 50s with the US in every single country, not every single, but mostly, I would say, the majority of every country in the world. Now, by the 60s, obviously, you have these world power struggle fighting each other, which is the Soviet Union with the US, which were the last standing economic powers. And during these periods, you get people who are born the child of the soldier from World War II, which is the baby boomer, right? And then those baby boomers start to see a very different world than what they saw as their parents. A world of great opportunities, per se, the American dream. And then their children get the opportunity of a bigger reach and wealth from establishment of investment that happened during the baby boomers' day, and that are paying good dividends later on, in which those grandchildren of the World War II veteran gets to enjoy the world much more, right? But then when they enjoy, they lose the psychological effect of what their grandparents have been through during the war, the war, because they never experienced a war up to that length. They don't know how it is to be incredibly poor, to fight with your neighbor, to fight with another country, because you both have a different concept and an extreme ideology from one area to the next. And you have a much more liberal state, and where people try to substitute that sort of struggle adrenaline, I like to call it, which is basically the concept of wanting to get into a tough situation when you haven't been through. That's why it's kind of funny, because when you look at people who not much has happened with their life, they want to do sometimes they want to stay that way, or sometimes they want to do something very crazy because they've always been, nothing has really happened much in their lives. And that's what happens as people get richer onto that point in that state. They start to get things so easily, and they sometimes don't appreciate it either. They don't appreciate it, the value that they have in that country, in this country, than people who live in other countries, right? And then these people start to become more liberal. They start to become more idealistic into what their reality is, right? And then this starts to build up with that. That was the reason why the hippies were born, right? Because you have these people, but the hippies were really because of the consequences that they saw from their parents from World War II, and that they didn't want that. And of course, when you Put that with marijuana, well, you get the hippies, uh, or you get like shrooms or something like that. But that's what happened in the '60s, right? And you have these pounding people protesting, and you have Black African Americans trying to get freedom, which amazing thing that happened about time that did happen. But it's just no matter a good thing that's happened, it definitely plays a role into what's happening overall. That's why to me, it's very important to become analytic about these things because you tend to separate yourself from the crowd because the crowd is just doing what the other person's doing. You don't want to become like that, or else you become a screaming rightist or you become a screaming leftist. Don't be either, and don't be a screaming whatever, right? Because you never want to be so hardcore idealistic because you don't know the other side and you don't know if that's the clear answer because that's just your perception, right? But whatever, I went through a tangent through there. I just that kind of went combined with somewhat psychology. But the reason why I explained that and most of all is because as time passes on in your generation, people tend to become, let's say, less appreciative and more access towards what they have, and that combination isn't so great in the long term, and it's not productive at all in the long term, right? And I don't think there's a solution to that. I think that will always happen, and that's why I believe a lot of people are going to hate what I'm going to say, but it's the reality that at the same time I see more the probabilities of the country to not be the most powerful anymore, but to still be powerful, right? I'm not saying I believe that will always be the way, because the U.S. knows a lot from that sense. I don't believe the US is going to stay at its top position forever. I think there will come a time when some country, I don't know who, right now it's showing to be China, but it really, anything can happen. A country could become the top power and they could stay in that on that pedestal for a very long time, depending on people deciding what they want to do and how to sustain that with productivity. The US did that very well, and the US will stay in great power. That's what happened to the United Kingdom. The United Kingdom was the most powerful empire in the world for a century in the 1700s during the actually the American Revolution. They were the most powerful country in the world for a century. But look at what happened. World War II, a lot of things came up in Cape Abide that they became complacent, comfortable to what they have. And the US didn't. On the other hand, the US wanted to produce an innovation, an industrial age. You had people like Carnegie, John D. Rockefeller, Henry Ford, all these amazing inventors, Thomas Edison, Tesla. You don't have these sort of people anymore, or at least you have them under disguised, like Elon Musk. But you don't have them in these type of quantities in different fields all at once. And that's inevitable to happen to a different nation. That's why I believe that these people, the country that revolutionized this sort of way of going about things was, of course, the U.S. It was really the boost of capitalism. China learned from that. That's why China became so successful, because they learned from a leader from Singapore, which was Lee Kuan Yew. You know, that's that famous saying that, you know, I don't care whether the cat's black or white. All I care is that if it catches mice, and if that cat can, that's a good cat. And that was the concept, right? And so that's why this is just by pure analysis, a theory, most of all, not a fact, but it's a theory, and no one has the fact, no one ever will, that this country is phenomenal and it'll always stay phenomenal. But I would say it's a safe, I'm not saying that it's required, but it's a safe way of analyzing to have an expectation low about it, that it's not going to stay always at its top position for hundreds of years. I still believe it will be at its top position in at least until I die. I don't know, maybe a few years afterwards, but I think the U.S. could stay at its top position ever since I'll die. But no one even has a clear answer to that. I think that this whole topic that we're talking about right now is good to understand, because no one has a clear answer whether, you know, the investments that you made over such a huge amount of long time can really flourish, because anything can happen, right? A hard asset is super crucial because it's, for example, real estate, or even the S&P 500, right? Or the global economy per se. I know for a fact that the world is going to be better off in 50 years than what it is now. And I know so that in 100 years it's going to be better than what it was 50 years. That's always going to happen. So you want to find that instrument, at least if you're looking for long term, if you're looking for maybe a wealth accumulation for your grandchildren, something like that. That's a good way to go about it. A great vehicle is the S&P 500, and also hard real estate, right? That would be, I would say the best ones is land, right? Land is super crucial. It was owned by a family. They owned the land. And can you imagine the amount of money? Like there's Orange County is a huge, important area in, I would say, in California, because you have a lot of companies in that area. So But it's that's the point that I'm trying to get across. If you bought Orange County back in the 1700s and you kept it till now, or maybe till the 1900s, where someone offered you, kept people developing, you're going to be a multi-billionaire from there. And I think that's in your grandchildren are going to continue to be so. So both areas, you want to find instruments like that. Okay, so towards this article, you can see that Federal Reserve with Nixon, because during this time, this is when Nixon was born. So you guys can understand again, to refresh your memory, under the Bretton Woods system, the external values of foreign currencies were fixed in relation to the US dollar, whose value was in turn expressed in gold at the congressional price of $35 per ounce. By the 1960s, of surplus of US dollars caused by foreign aid, military spending, and foreign investments threatened this system. And as the United States did not have enough gold to cover the volume of dollars in worldwide circulation at the rate of $35 per ounce, as a result, made the US dollar overvalued. John F. Kennedy and Johnson adopted a series of measures to support the dollar and sustain Bretton Woods. Foreign investments was disincentivized. There was restrictions on foreign lending, efforts to stem the official outflow of dollars. Then you have the international monetary reform and cooperation with other countries. Nothing worked. Meanwhile, traders in foreign exchange markets believed that the US dollar was overvalued, would one day compel the US government to devalue it, and it proved increasingly inclined to sell dollars. That's why it said it was just short on the dollars. That's what this article is saying too. This resulted in periodic runs on the dollar. Yeah, and then this is exactly what happened. I think it's important to understand because history does not repeat itself, but it does rhyme. There is factors that you can learn from the past exactly what was going on to see. I'm not talking about macroeconomics, even though this is macroeconomics, but it does play in to understand the most important that I like to grab about this stuff is to know relative to what you want in assets and which ones are to go with that, and to know what's the U.S. position. And third, the market might come down. That's the most important thing. Okay, high, whatever excuse like this. Okay, it's going to potentially come down more. That could be a time that we could utilize during that time of the price market coming down. We can accumulate cash during these periods, and then right when the market's coming down, right? Of course, it's good to invest a lot in through any time if you're looking for the market, but it's better to invest when the market's coming down because it's sure to go up more. It's always like that. That's how the market's going up. Look, every time the market has come down, what has happened? Sure, the market's come down and it's gone down more, right? But at the end, if you look 10 years ahead, or let's say 58, look at this. The market went down in 57, and look at this rise. Did it really matter whether you bought here or you bought here? Yes, it hurt in the short term. If you see it that way, if that hurts you. But I think the best mentality is to not hurt at all, that you're just looking for 20 to 30 years. But when you buy over here, right, the price is going to come down, and it definitely can come down, right? And then you buy more. Maybe you buy here again, and you buy here again, and probably buy here again. So you bought different positions at different prices, right? But does it really matter if in 8 years you bought at 496, and then let's say 10 years later, towards 1968, there you have it. Does it really matter that the market was costing $498 and the market went down? Now, 10 years later, it's at 970. Right? Does that really matter? See, so that's why I believe that the best thing that you could possibly do in a downtrend is have cash and buy. And if it goes down more, buy more. Right? But don't do this. I'm only saying this for the index, not for any index. But I'm saying this specifically, the best to do it is the S&P 500 now. Before, in the 60s, it was the Dow Jones. The Dow Jones was the best because it was the most solid. But now it's the S&P 500, and it would be also the Dow Jones if you wanted to. Just keep in mind that the Dow Jones has 30 of the biggest companies. Now you might be saying, okay, then what's better? Well, if you have 500 biggest companies in the world, I'd rather have it in those 500 biggest companies because it gets to diversify. I also believe that if you want to diversify a lot, I'd rather just buy the S&P 500 than just do it a lot myself. That's why I find kind of like the arguments that people have in diversification. If you're really just looking for diversification, there's nothing else better for the S&P 500 because you're sure guaranteed to beat any hedge fund that tries to diversify hugely, because there's no person in the world who has high accuracy or high metric. No one. This is a fact. I'm telling you, no one has a high metric to really beat the market consistently in the long term. But there's about a rough estimation, right? But if you buy the index, you're always going to outperform all the people who are trying to diversify, because you already have all the 500 companies and you don't have to do anything. You just have to deposit, and the index will just reform itself into what companies are now relevant in 10 years and 20 years compared to now, right? So that's the best way that I like to go about in diversification. When you want something more concentrated, of course, it's better to invest by your own and you get a better return. But in this case, I was talking about this because, you only want to buy when the price is coming down in a really good business or in the S&P 500 or in the Dow Jones. That's it. You do not want to do this for every business. For example, you're not going to want to do this for all the 500 companies in the S&P 500, even despite I told you that the best one is the S&P 500. Why? Because when you buy one of the S&P 500 assets, you're just buying one, but you're not buying 500. You see the difference there? And you don't have the adjustability to swap the different assets at a relative pace because you're not a machine, or at least you don't have many people organizing this stuff. So that's where the best solution, if you want to diversify, just buy the S&P 500.
So you might be saying, okay, then if the S&P 500 is filled with the 500 biggest companies in the world, then why doesn't almost every hedge fund or mutual fund do this? Well, that's exactly for the reason. They're trying to sell you. Why would a mutual fund hold the exact same companies in the S&P 500? And if this was also the case, then we could also say that almost a lot of different mutual funds would be doing the same thing. So then why would you or anyone else want to put your money in comparison to another hedge fund? See, like the competition there reduces because there isn't any incentives. There isn't any materials for you to go there because of a specific preference when it's almost the same asset. That's why mutual funds and hedge funds constantly allocate and modify their assets to make it seem like they're more attractable and they're more adjusted with future returns. But that's really just all a slight increase and there's really no difference. More of those technical terms are meant to sell the clients that wants to put funds into their firm. But other than that, using the S&P 500 is the best.
If you want to outperform, the best approach is really having a bit more concentrated portfolio. You don't need to own 30 companies or 40 companies. You do if you want to. I have nothing against that. But I'm just saying that the more that you diversify, obviously you're going to have a lower return. But I don't think the return, neither the risk, is worth it compared to just buying the S&P 500 if you just really want to own and get money, let's say, quick in 10 years. Although keep in mind that the S&P 500 does not deliver extraordinary returns in 10 years. It delivers you extraordinary returns in 50 to 60 years. So think about it like a 401k, really, if you're thinking about. Now, in a great business, all the time when the price is going down, you always want to buy, right? But of course, it has to be intrinsically undervalued. And that's what I want. All these different things we're going to talk about in the course. I'm going to be talking about index investing, how to averaging your position, dollar cost averaging, what's the best index to go into, why so, how is it cheap, where to exit. You guys are going to learn a lot of this, but this I wanted to create as a foundation, all what we're learning here, so you can have the mentality that no matter what happens in the future, because guys, to be honest, I'm a human. I don't know what will happen to me tomorrow or next week. I don't want to create fear or anything, but I want you to have the stability and surety that you have a wide amount of resources to really know, okay, is what I'm doing correct towards my expectations? If it is so, if I want to make a lot of money, is this the right way? That's how you can go about it with that. And I think it's really great to learn about this stuff because, anything can happen to me. I don't know what will happen tomorrow or next week. And same to you. So I really believe that, one, utilize the time you have, and two, learn the things that you don't know, right? And a lot of these things can be the ones that I'm showing you right now. But this will give you such a foundational structure that a lot of people don't have in order to go about the markets. And I think you guys know by this point that I think you agree with me, because there's a lot of things that the market does not really care about. It keeps going up even when the people want it to come down. It keeps going up when the economy is under distress, right? So that's why you have to have a long-term position, because the markets do come down. You see, it does come down here, but it doesn't stay down a long time. And you want to make sure that during these times you have the cash to buy these businesses or an index fund, right? And I'll talk about one of the best 8 index funds in terms of expense ratios that charge you less expense ratio. All right, so we're now in 1970. So now we're in a period of the stagflation decade. And right in 1971, the Bretton Woods system, the US dollar got disconnected, right? And it got disconnected because of the amount of circulation of dollars was more than the amount that you could get in value with gold. So for example, if you had I can't give you an exact number, but this is an example. If you had $2 trillion, right, and you have in gold only about 800 billion, right? That's about more than double of what you have in gold. So that means you're leveraged really by double. And if you go under, you're more sure to go under because you don't have anything else to back it up. It's like simple personal finance, right? That's why I love to learn about this stuff, because the government is the same way as you and I, right? The government is like a company, right? The more assets you have compared to your liabilities, the better you're off in the long term, because one, you're going to be paying less expenses. Two, the amount of returns that you're getting into assets are going to be way more able enough to pay the liabilities, and you're going to have a cash flow there. The more cash flow that you have, the more financially independent you could become. And that's what the government is. It's the same exact thing. In this case, when you have more dollars compared to what you can in these times, the amount of dollars that you can exchange it with something valuable as gold, that would keep people to trade more, right? But when you have more dollars to the amount of gold that you have, there's a dislink there. There's a margin of error on the amount of unvaluable assets compared to valuable. So it's like liabilities. If you have more liabilities than your assets, if something bad happens, you're going to be broke. And that's what was going on in the US. Of course, the US is a bit more complex in its balance sheet because of the amount of assets and liabilities and the way how it makes money because of its citizens, like taxes. But it's the same thing, right? And that's the problem with the dollars that were going on in these times. And that's why Nixon was forced, because of the Vietnam War. It wasn't because of Nixon's fault. It was because of many different presidents that did it. In Federal Reserve, it's no one's fault. It just came to be. And he was forced to dislink the dollar, right? And I think many people are going to disagree with me. Many people have a personal affiliation, a bad image about Nixon. And that's perfectly fine. You could stick with your opinions or beliefs, but that's what happened with Nixon during these years with the Bretton Woods. And in this time, this affected the economy, obviously, but in the long term, it didn't affect the markets at all, because markets is not the economy, but it affected it several years later when other bad consequences happened. And that's what propelled inflation a lot more higher. But during these, you can see that the market responded negatively for the next 7 months, but the market bottomed, even though there was more higher inflation, because, there's not much worse to go about that. Not much worse to the amount of news that they got. And by 73, you had I don't know if I'm pronouncing this right, the Cooper oil crisis. And this is officially what absolutely started stagflation. Stagflation was born in 69, but what really started it, what kicked the flame, the ignition was here, but what expanded the flames further was because of the oil crisis that happened in 73. And let's see, you guys can understand what happened. So by 1973, there was an oil shock. And in these periods, energy prices skyrocketed. There was fuel shortages resulting from an embargo by Arab oil producing nations in response to the US supporting Israel during the Yom Kippur War. So it was a geopolitical issue. There's a meeting in the world, and it still exists. It's called the OPEC meeting. And the nations that have the biggest amount of oil, you guys know that the ones who obtain the most oil right now is a lot of the Arabic countries. Right now, that's the United Arabs, and the prince over there as well. He owns the Aramco Corporation. And a lot of these people have a huge amount of money, like in Dubai. That's why they built all these things, because of the amount of power that they have in oil. In response to this, because the U.S. supporting Israel during a war, and if you guys are interested, the Yom Kippur, it was an Arab and Israeli war. So that's why. It was the Arabs fighting against Israel. And of course, the Arabs are not going to like seeing the U.S. supporting the Israel, which is their enemy. And hence, they told the U.S., oh yeah, well, we're going to now increase the amount of price you can get per barrel of oil, right? And that caused a worst effect for the U.S. economy, because the U.S. economy was under a big amount of inflation. And this caused more inflation because energy prices rose, gas prices rose, not much people could spend more. And you see that that's why it's called stagflation, because there was a lower amount of unemployment, similar like a depressed, not much into the demand. People can't get as much loans as they used to. And then there's this other article, which we'll read in a second, but that's what happened. As you see this, in this period, the price of barrel of oil nearly quadrupled in less than a year. And that was in 1973. And look what happened in 1973. Yeah, very, very bearish. A lot of fear, right? Because of the oil crisis that happened during these years. And the war started in October 6, 1973. Although, let's see exactly when. Okay, that was on August 73. So that happened here, or it went down more. Of course, there was probably tensions. That always happens. That's why I'm telling you that the market's not the economy. It happens. It factors in. It was probably anticipating for that to happen, and people got scared of selling. Because the amount of, let's say, tension. Something like the U.S.-China trade war. It didn't happen yet. There wasn't this war going on, but there was fear that it might spark it. And that's why the market sells, because people don't want to buy, and then the market comes down. That's the whole point why people short the market. Because they're fearful that when they buy now, maybe in 1 year it comes down more than the price they bought it for. So the people who bought over here wants to collect their profits, or they're selling because they don't anticipate the price to come up more because they're anticipating for probably a tension, a final confrontation with Arab nations with the U.S. That's why the market reacted that way. And when it actually did happen, instead of the market coming down more and more and more, the market rallied up. So you see, that's why it's unpredictable. But of course, in total, there's probably worst events going on here that some sudden situation happened and the market came down. You see, like it's like, that's why I compare the market to like a person addicted to every drug, because they give you one price higher and then the other price lower. It's like up and down, up and down. That's why people are very fearful of the stock market, but they don't know how to utilize it to their advantage. And that's what we're learning. That's what you're going to learn all about in this course. Not to be a victim of it. You don't never want to be a victim of anything, but you want to turn it in your favor. You want to turn it in favor of this idiotic price movement that people are going to think that the U.S. is going to come collapsing in 20 years. No, it's not. But you need to take advantage and start buying. The price can come down more, but it doesn't matter. Just keep buying and keep buying, right? And then as time goes by, you bought over here and you bought over here, and all these people that sold out like morons are missing this return that they made 3 years later. See, this is why the market is not the economy, and you don't want to follow the crowd. But at any rate, that's what happened in 73 and 74. And this was the main cause. It was just the oil crisis. But let me tell you this, so you guys can know as a quiz. Did the market go down primarily because of the oil crisis? No. It went down because there was already inflation. The Bretton Woods ended. Unemployment was rising. Inflation was rising. Interest rates were potentially rising. And then out of nowhere, can you really predict that the Arab nations would quadruple the price per barrel back in 1971? No, you didn't. So that's why I'm telling you, even, and that happens, you need to understand these factors even today. You can't predict what will happen in 2025. You really can't. Anything can happen. But you need to understand that whatever happens in 3 to 4 years does not matter at all in 10 years. If you bought here in 1966, when a few years later, that huge, let's say you bought it here at $773 in 1966, and you saw that it was a good time to buy, and market factored it down enough, and this was a perfect example of just a regular recession. Did you really predict that Nixon was, or not even, like, you didn't even know who Nixon was, because Nixon was probably not even president in this time. Okay, it was 69. Yeah, so it was before. The president during that time was Johnson. I mean, if you bought here, were you really able to predict that in 1967 the price would go down again, and then it would go up, and then by 1969 did you really predict that the economy would then have to confront it exactly in 1969? This high amount of inflation, this high amount of unemployment, and a fear of global recession? No, you didn't think of that. Everyone was already thinking of a recession here, and people didn't think of another recession 3 years later. But you bought at 730, you bought at 760, and the price went up all the way to 980 and went down. And it went down towards the same price that you would have bought. What would you do there? Would you sell? Well, I don't know, but I would buy. I would buy again. Price went down lower, I would buy again as well. Right? And during these times, this was the fear of inflation. And then during these times when you bought here, did you really predict that exactly a year later that Nixon and the Federal Reserve would dislink the dollar, erase the Bretton Woods system because of the high amount of disconnection and valuation from the dollar and the gold? No, you didn't. And you didn't even anticipate that the first time you bought. And during these periods, let's say that you took advantage of the price coming down, you bought here and you bought here, right? So it's now 800. Now what you're buying it at a higher price, and what you bought before, prices are unlikely to go back to that level. Well, that's what's going on. You bought here, and let's say a year later, did you really predict on November of 71 all the way to January 73 that the market would come down for the next 2 years just because there was going to be a new coup war and the Arabs forced the U.S. to pay at 4 times the price of barrel that they used to, and gas prices would go up? No, you didn't. So this is why no one in this world, no banker, no billionaire, no trillionaire, which will happen later because of inflation, no one in the world is ever going to tell you what's going to happen next year and what's going to happen in 2 years. No one. But you have to be willing to be in a position that you could say with certainty that you're entering in a good instrument, in a good price, and that in 10 years, you're much more higher, and you've seen in history that you're much more higher to earn a big amount of money compared to selling at that point and then selling when other people want to. No, you want to hold for the long term, right? That way, if in 2 years, if another world war happened, which God forbid it, but if another world war happens in 2 years, right, I'm going to be in the position to still buy. and still keep to buy. That's the mentality you need to have, right? And a lot of people are not going to have that mentality because we're humans. We're a creature of fear. Fear is a product of the human nature that was essential in surviving. That was when you were in a cave and you saw a dinosaur or you saw a tiger, and you had this immense fear, and that was very good to have. That was a very good quality because it would keep you away from that tiger. Nowadays, people have that fear not in the physical world, but in the mental war per se. That people are fearful because they're not going to be willing to pay their mortgage or their electricity bill or their car or credits in the next 4 weeks. Right? You see the difference there? Or people are not going to be fearful to invest a big amount of money just because the crowd losing money from previously. See, the fear is not necessary because the financial world works on consumption and production, and you need to see it in a solid way. You shouldn't be selling and going towards everyone else is going, because that's likely where a lot of the bad practices and a lot of the worst returns are going to go to. And that always happens, right? But many people go there because of fear of the good returns. People get fearful when things go up and down, they lose money because they have an emotional attachment to it, because the only sort of byproduct of survival now is, okay, what's in your bank account? But you see, like, that didn't exist 400 years ago, or at least it didn't exist thousands of years ago when you had to face creatures in the world. That's why you need to be in a position to understand that it is beyond your control what's going to happen in the next 2 or next 3 years. Anything can happen, but you need to have a position to say, if the market goes down, despite the selling, despite the reasons, any reason anyone throws at you, any reason, you still want to have the cash to buy the businesses you like to buy, because the businesses are not based on macroeconomic predictions, but it's based on what the business produces, what the business will produce later in the future, based on its attributes on the business itself, what it's selling, what its management, all these sort of qualities I've learned from people who are way ahead of me, and they will always be like this. That will never change. And this is why this is so valuable to learn. And I would say really listen into what we're going to show you, because a lot of people don't understand it. And it will always stay that way. But you want to make the decision that in the next year, you can't predict anything, right? And you have to, and that's such a healthy way to look about life, because no matter who is going to say there's a recession, whatever, you're just going to take it as an entertainment purpose, and you're not going to take it seriously, because no one has the answer. No one can. No one can give you and tell you that you're going to make this amount of return in next year or 2 years or 3 years, no matter how intelligent that person is. Not even Elon Musk. Elon Musk does not know what he's going to be doing in 2 to 1 years, but he knows that the practices that he's going to do right now are over going to exceed the expectation of what he thinks later. That's why I believe that you need to overwork and oversmart yourself by doing the things that you don't know and doing the things that many other people are not doing. And that requires unique behavior, right? So I don't believe that you have to be a billionaire or a millionaire, but you want to be the person you want to be. And if you do want to become a billionaire, become a billionaire. It's what you're supposed to do. It's what you were meant to do. If you want to help people to the fullest, is what you're supposed to do. If you want to make entertainment shows, do that. Like, I'm just showing, but if you want to make money in the markets, you need to dislink yourself from people and buy when everyone is selling into, obviously, a stable asset, like a good business, not a stock, right? In this investing course, I don't teach you to invest in stocks. I teach you to invest in businesses. And this is why I've gotten a unique approach with this, because I don't invest in the common way that people do, which is buying based on betas and Greek mythology and calculations. I don't do that. I'm just going to say that right off the bat. I invest in businesses, and I've outbeat the market in 2022 by 400%. And I'm not trying to say this to impress upon you, whatever, but I'm just telling you that stocks move in the short term anywhere they want to, but they always reflect the value of the business in the long term. And you need to always understand that with absolute clarity, even if you had a concussion. It's to that point. You need to understand that when you see the price coming down into a good business that you want to buy, that's your instinct. You need to do the reverse of people. When the price goes up 90 degrees, you don't want to buy. Neither do you want to sell. It depends, right? It depends if you like how much you're gaining, if that's what you want to do. But if you're holding a very strong business, you want to hold it for the long term, right? And that's what I wanted to show. That over years, the stock market in the short term is a voting machine, but in the long term, it's a weighing machine. Those who vote in what happens in the short term gets to move the market wherever they want to do on voting, right? It's not one person. It's many reasons. What are these many reasons? High inflation, high unemployment, a global anticipation of recession, a Vietnam War starting, like what we saw over here, an oil crisis with a great anticipation of inflation, or inflation already rising, the end of the Bretton Woods, high unemployment, all these sorts of things. And you had more reasons here than before, and that's why the market went down more. But are you going to sell? No, you're going to buy. You're going to keep buying. You're going to keep buying. Happened over here. And look, 1975, despite worst inflation, the price went from 575. And believe me, I can tell you from experience that when the market has come down a lot and you see a price where you think to yourself, can it really go up higher? Yes, it can. Remove that, like it can. It can. And it's very likely, it's an 80% chance that the price is never going to go back here again. See, that's why it's so valuable to utilize crises as an opportunity. You want to make sure that when next 2008 happens or whatever happens, you want to make sure that you have a high amount of cash and that you invest in all the businesses you can think of. Because I'm telling you, the rewards are going to reward you hugely than everyone that sold that year. It's going to pay you huge dividends. That's what I'm going to tell you for sure.